Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video, I'm going to talk about 3 different ways that you can trade your options. And the strategy I'm going to talk about right now is selling to open puts. And it's a very good, simple strategy for anybody who wants to make a little bit of money at a pretty halfway decent rate of return. So as you know, if you watch my video, I own 200 shares of Steel. That's the chart we're looking at right now. I also own 2 call options, $15 strike price, expiration 2021 of January. And I own 6 $10 put options, expiration January of 2021. And this chart we're looking at right now is very interesting. This is a 5-year chart, okay? And if you look here, Steel has pretty much been doing nothing but going down, but I'm noticing that there's a little curve at the bottom, okay? And sorry about that. Let me eliminate this. Now, when you look at this curve, okay, I see lots of sharp moves, but I don't see any curves in this entire chart here. So when I see a rounded curve here, maybe that could signal a reversal. Like you'll notice a curve here, right? The curve here, and then Steel popped up a lot, right? No sharp moves there. Like we have a sharp move, sharp move, sharp move, and then a curve here, big drop, but then it curved. So curves are, to me, a stronger signal that maybe a change is in the wind. The sharp moves, that to me is more market volatility, and Steel is about as volatile as they come. But the curves, to me, are very good signs. So how can we take advantage of this curve? I got 3 different ways that if you want, you can buy and sell options. And let me say right here, right off the bat, that options are risky. Trade at your own risk. You can make or lose money depending upon how much money that you place your bet. So let's take a look at these 3 option trading strategies here. So first, let's go to a 5-day chart. Now, if you trade Steel, then you know this big hunky-dory move here was the earnings, okay? And Steel really went up that day. And I've noticed just in the last 5 days, there's a new pattern that's being formed, and the top of the pattern is up here. It's about $13.75, maybe $13.80, and the bottom is down here, which is at about $13 a share. Now, if you were going to sell puts, then what you might consider doing is going to your option chain right here and looking at the 3-day puts at the $13. Now, again, if we go back to the chart, that's support, so there's nothing crazy or dangerous about that, right? And you would have to set a stop loss, okay? Your stop loss would be the premium minus the price of the shares minus the premium. So the premium that you would get would be the bid 22, the ask is 23. You're paying 70 cents in fee, in a contract fee for the put. So let's say 20 cents. That means your stop loss would be at $12.80. So your stop loss would be way down here. So if Steel dropped, let's say down here, and this is by this Friday. Today is November the 5th, Tuesday. So if you see Steel drop below that level, then that's your stop loss. That means it's time to get out or try to make some kind of a change. I don't know what you're going to do to hedge it, but probably you just have to buy the close and just get out and take a small loss. Okay. Now, the return that on that investment is very good. Okay. Now, $13 strike price, so that's $1,300 that you are investing in this small, let's say $20. Now, $13 would be 1%. $26 would be 2%, so you're looking at about a 1.5% return in 3 days. Okay, that's pretty freaking good. Now, if you're making 1.5% a month, let's say, and you were able to do that for 12 months in a row, imagine making just a 1% return in 12 months. That's a 12% return. Well, here you're making 1.5% return in 3 days. So that's a really crazy good return, but it's a little bit risky because, I mean, you only got till this Friday before the put expires. I'm looking at the 3-day puts. The bid's 22, the ask is 23. And could Steel hit $12.80 or lower in the next 3 days? Of course it could. And so you would just very simply have to set a stop loss at that $12.80 level. Okay, so that's trade number one. Now, trade number two is to go to the 3-month chart here. This is our 3-month chart. And I'm looking at, sorry about this, I'm looking at this level right here. I'm looking at $11.50 for 3 months out. Okay, and so what I would do is, and this is your second idea that I'm giving you, is I would look at put options and I'd look at the $11 strike prices. And so for 45 days, your risk is $1,100. That covers the strike price of the put. The bid is 28, the ask is 29, expiration 45. And so if Steel traded above $11 a share in the next 45 days, 1% would be $11, 2% would be $22. So you're looking at about a 2.5% return in 45 days. That means in 3 months you're making a 5% return. In 12 months you'd be making a 20% return. That's very decent, don't you think? So, and again, if we look at the chart, it's pretty safe. That's a more safer trade to make than the first trade. The first trade, it only has to go down here. Now the second trade, you're trading all the way down there. That's $11 strike price, and you're getting $28. That means Steel would have to go all the way down to $10.72. It would have to go all the way down there in the next 45 days. Could it do that? Of course it could. That's why you set the stop loss. Now we're going to go to our third trade, and this is the safest of them all. Okay, the safest is just to use what I call the granddaddy support of all support, and that's just to go down to the $10 level. Okay, and this is a 1-year chart, and again, when we look at the 5-year chart, I think it's safe because there's a rounding, right? I don't see the sharp edges. Sharp edges tell me volatility. Around like this, when I see round curves, that tells me that maybe the trend is changing. I mean, notice how that's kind of round and it popped up, right? Notice how round that is and it popped up. But you see, when you see sharp jutting moves like that, then that's just volatility and it just goes up and down, and that's what Steel does. That's the name of the game with Steel. But here we have rounding. So I think that if we look at the 1-year chart, to me, this is also a very safe, and I think this is the safest of all the trades right here. And it's just very simply to sell the $10 strike prices with your puts, and I would go 73 days out. That's about 2.5 months. And the bid is 25, the ask is 26. So for $1,000, you're making $25. That's a 2.5% return in 73 days. Now, 90 days is 3 months, so if you were to make that 2.5% return in 3 months, then you would get a 10% annual return, and that's the safest of all. Of course, it has the lowest possible money that you can make, but it is the safest, because in order to lose on that sell, on that put option, Steel has to go all the freaking way down, and it has to break all the way below there in the next 73 days. So those are 3 what I consider to be pretty interesting and good trades that you can make. So again, if you want, you can trade off of this 5-day pattern and sell a put option, expires in 3 days, and try to make that percent return in 3 days. I think it was let me see if I can remember here. The $13 the bid, so we're looking at a 1.5% return in 3 days. That's a heck of a good return there, right? But again, I mean, if we go to the longer charts, you know, Steel has a tendency to make very fast moves very quickly, right? But in order to lose money selling puts, I mean, you have a 75% chance of being right. If Steel goes up, you make money. If Steel stays flat, you make money. If steel goes down a little bit, you make money. In order to lose money selling puts, it has to go below the strike price and then some. It has to go below the strike price. Like, for example, on that $22 put, on the $13 put that you get the 22 cents, steel would have to, if steel went to $13, 13 minus 22 would be $12.80, $12.78. If steel went down to $12, let me go to the 5-day chart, easier to see. If steel went down to $12.78 right there, you don't lose any money, you just don't make any money. In order to lose money, it has to go below that stop loss. And if it does, then hopefully you're not stubborn enough to hold on and say, well, you know, I'll just hold and hope it comes back. Hopefully you have the wherewithal to set some stop loss, because you got to do it. Okay, you lose a little money and you make a lot, or even just a little more money the next time. And I think this put selling strategy is a pretty good, safe way to make money. So again, 3 ways: $13 put, or you can sell to open. Holy crud, let me eliminate all that. You can sell to open this $11 puts, 45 days out, and the return's less, but the risk is less. Still would have to go all the way down there. And then the final way that I gave you was this support way down there. So, as always, if you have any questions or comments, if you like what I'm talking about, if you like the ideas that I'm having you, hope you get out there, make some money, sell some puts. I think selling puts is a very nice, safe, and sane way of money. And just keep in mind that whenever you sell puts, that's an alternative way of buying the stock, right? Because if the shares are put to you, then you end up buying 100 shares for every contract at that strike price. So let's say that you sold those 90-day puts, or I'm sorry, the 73-day puts. Let's say you sold those 73-day puts, and where is it at? Let me go in the money here. I'm sorry, let me go out of the money. I'm losing my mind, aren't I? Let me go out of the money. Here we go. So $10, bid 25. So if steel went down to, let's say, $9, then you may just be so inclined to buy a couple hundred shares of steel at $10 a share. Would you have a problem with that? I've sold $10 puts, and I think $10 is a very good price. So that's it for this video. And like I said, if you have any questions or comments, feel free to leave a comment. Thank you all for your support and for your viewership. I will see you in the next video. Have a good day, and ciao.